Well, I've got quite a history with a company called Peregrine. Way back in 1999, when listing my first internet startup, it was listed by Peregrine, and they were owned by the same, people that had a big investment in my company. So it's such a pleasure today to be talking to Jacques Conradie, the CEO and portfolio manager at Peregrine Capital, which was the very first hedge fund in this country, and the performance has been, outstanding. We'll get onto that in a moment. Jacques, your colleague and chairman now of Peregrine Capital, David Fraser, was trying to educate me about hedge funds around the time you guys started it in 1998. And if only I'd listened, because I see your returns in that period have been quite spectacular. But it was early in the South African market. Was your hedge fund the very first one?
I think it's certainly the longest running one, Alec. I think at the stage when Dave started the business, the only other people that could trade hedge fund-like instruments was the proprietary desks on the banks where they traded. But I think in terms of being a vehicle for external investors to get exposure to the types of investments hedge fund can do, I think we were the first in SA, yes.
So nice and basic. Tell us what a hedge fund is.
So I would start to say it's similar to a normal collective investment scheme where our goal is to buy and sell shares to create wealth and generate returns for clients over the long run. The key difference then versus a long only that everyone knows versus an Allan Gray or a Coronation is that we've got a wider tool set. So we've got the ability to bet against companies by going short. If we think a company will perform poorly or underperform, we can bet against that company. And additionally, we've got a wider access to tools like derivatives like put options on the market when we want to protect against the overall market declining. We don't have to sell our shares. We can buy almost like insurance, like you buy insurance on your house or car. We can spend some premium or spend some return to buy protection on our overall fund. So we try to achieve a similar job than a long institution, but with a few additional tools in the shed.
Okay, and the name of hedge would suggest that you offer insurance or protection against bad times, but do you outperform in good times?
I think that there's two clear goals here. As you said, our job is, and I think what our clients want from us is in down markets or in times when things are tough, we want to do better than equity funds or than balanced funds at that stage. And I think we and some of the other leading hedge funds have certainly done that. Then the trade-off there is you try to run the portfolio a bit more conservatively. We've got lower volatility than the typical long-only fund, but we want to make sure that over time, we also keep up with markets through the cycle. So what you tend to find is in a year where the market just runs 20 or 30%, like maybe a 2021 or 2010 after the global financial crisis, in those years, we might find it slightly harder to fully keep up with that raging bull market. But because of the fact that in the years where the market will be down 20 or 10, we might often be flat, we might be up, we might be down slightly. Through the cycle, it adds up to us hopefully significantly outperforming the market or the balanced fund category. But the times when we must really shine for investors is in sideways or in down markets.
Yeah, and not lose money. Lesson number one.
Yeah.
Mr. Buffett. But going back, so it'll be 25 years that the hedge fund began, or that one of your two hedge funds began, in June this year. So it's a big celebration for you. The performance over that period of time, if I'd given you R1 million when you started, if I'd had R1 million to give you when you started, what would it today be worth?
So Alec, we've got two flagship funds, the high growth and the pure hedge fund. If you invested R1 million in high growth, that would be about 130 million rand where we're sitting right now. So about 130 times. I think we're the only fund above 100 times. And then pure hedge, which is our much low volatility fund, that million would be about 75 million right now. And I think the interesting bit there is that's been done while never having a negative year. And I think that might be, I can't think even globally that there's many hedge funds around that's done 75 times money, but without ever having a down year. So while always managing the downside volatility in that time.
Just say that slowly. So if you had R1 million into either of your hedge funds, the one would have gone from 1 million to 130 million today, and the other one from 1 million to 75 million. Have you got anybody, or have you got any clients who've actually had that run? that right?
There is Peregrine Holdings that invested on day one, was they helped seed the fund, so they put some capital in. Obviously, over the years, they've taken some of that out, but they still had a bit in. Obviously, David had some money in from the start as one of the founding people in the hedge fund, and I think there's probably one or two individual investors that's been in since right at the start. Now, obviously, right at the start, it was a very niche and new product, so you probably had a few friends and family and the seed money, but fairly rapidly within the first 2 years, we had many more clients. So there's going to be many clients with kind of close to that, but obviously from day one, it'll only be a handful.
Yeah, that the power of compounding. Jacques, your own background is real interesting. And without being immodest from your side, you were Stellenbosch University's equivalent of the Ducks. Now, I never knew this existed until I started researching it. The Chancellor's Medal, and I see in 1964 there was one R.P. Botha. I think that's probably Roelof Botha, the famous economist and the father of the other Roelof Botha, who's now the manager or the managing partner at Sequoia. And then in 2005, one DJ Conradie, who got the award for actuarial science, and you're an actuary, so I presume this is you.
Yeah, that's correct. That's right, Alec.
That's extraordinary. Did you have to work 14 hours a day to be the best student in the whole of Stellenbosch University? It must take some. Well, it does take some doing.
I think my first year there, I think because I'd worked ahead at school with maths and done some university maths, the first year you could still have quite a balanced life. Played a lot of hockey, obviously went out a bit and saw friends, and probably the first bit of second year. But I've got to tell you, from the middle of second year and third year, it did feel like those 12 or 14 hour days to try to get kind of 90s plus for exercise. So yes, it certainly doesn't come for free. You got to put some hours in.
And why? Are you from an academic family?
Look, I think my mom's a school teacher. My dad is he's got a PhD in physics, and he works at he ran actually the particle accelerator in Cape Town. So he's quite into kind of science and numbers. But I don't know. It's I think probably from my family and from myself, I think, I don't know, you kind of like to win stuff, and that was at university. That was the thing to go for if you're academically inclined. So it's almost that drive to succeed that kind of, I guess, pushed me to work really hard to go for this.
A lot of it is in the genes, and now we've just heard why. Your favorite TV show, Big Bang Theory?
I do like Big Bang Theory a lot, yes, among others, but that is great.
So now I'm talking to a guy who's clearly very bright. There's no question. You don't win an award like that. But Warren Buffett often says that being bright and being a good investor are not necessarily required, in that you need to also have other skills, or you don't really need to be that bright. He reckons you've just got to have your emotions under control when you are investing. Would you go along with that?
I'm a big fan of Buffett, Alec. I've also done my pilgrimage to Omaha there for one of the annual general meetings, and I think that's kind of that's wise words. I think you need to be smart enough. Like, I think when we hire people, and I think if we look at the other funds in SA that's successful, you need to have a certain level of smarts about you to figure out what's going on. But other than that, I would say common sense is so much more important than kind of pure brute force intelligence in this game. And then I think that point you made about emotions, it is, if you look at the big successes and failures, it's basically keeping your head in markets when others are losing theirs. And it's much harder than it sounds to, when everyone's selling it looks like things are going to fall out of bed, to then be the one that steps up and buys. And when everything's euphoric and everything's green and people are feeling good, to then have the willingness to sell. I think that's the kind of things you got to learn by reading Buffett, and you're not going to find that in academic textbooks. And then by getting the hard experience, making the mistakes and making the notes and trying to be better next time. So there's certainly much more than purely smarts that goes into this game.
And also, you've got examples of that, no doubt, over the last 25 years. Can you share one or two with us where maybe where you did buy into something that's done particularly well for you, and then sell a position that, or go in short on a position that proved to be correct?
So I'll try to give you maybe think of one or two maybe successes or failures. I mean, let's say in the recent past, I think we did very, very well as a fund to react during COVID. So we aggressively protected portfolios in the few weeks leading up to COVID. I mean, there was this one weekend. I mean, we all saw this in China, and Wuhan, and markets didn't really move. And then I remember there was a weekend where you started seeing some cases in Italy. Italy had like 3 cases on the Friday, and then by the Sunday evening there was like 100 cases. And I remember that weekend, like we were like our whole team was just messaging at like, this is much more than the market thinks. And we said, okay, let's all come in at 6 Monday morning, and we got to figure this out because people are going to figure out this is not just something that's going to stay in China. So our whole team got in early in the morning, had like a 2 or 3 hour debate on this, and then said, okay, we got to protect most of the portfolio here. There's something that could happen that the market's not pricing in. And fortunately, being of boutique size, we could do that using S&P futures, protect like half of the fund with put options. And I think it's almost sometimes nice in SA because we woke up before the US smart guys wake up. So there's a few hours to react before they wake up. So moving fast. But then after that, realizing that you've got to buy technology shares here. The whole world's kind of locked inside, and I think 2020 would be the year of the technology shares. So into weakness, we then bought tech shares, which ended up working very well. But we then learned a very expensive lesson, and that was as they ran up into 2020 and 2021, you know what happens is when something does well for you, you like it more. And we started, unfortunately, making the mistake of, to some extent, liking these shares more as they went up. And unfortunately, when the shares more expensive, you've got to like them less and sell them. And despite learning that lesson many times, it's easy to make the mistake there. And unfortunately, didn't sell them in time. We banked some, but then gave away some of that in 2021 again. And I guess that was a key lesson that then last year helped us. Last year, we had a very big winner in Thungela coal. Kind of David and myself worked on. We identified it early, saw the issue that the shortage in the global energy markets that would be caused by this Russia-Ukraine war, and just owned that. It was a fantastic 10-bagger for the funds. But then when it got to fair value, luckily the tech mistake was fresh in our head, and effectively just decided, let's sell this whole position. We love the business, we love what it's done for our investors, but it's there to serve a purpose. Kind of let's bank all of those. So those are maybe two kind of recent stories where I guess both made some mistakes and had some successes.
I watched the video that you and David had, the conversation you had about Thungela, and was intrigued to see that you didn't just sell it because you felt that it had got your fair value, but you sold it because you were also concerned about a bigger picture, specifically with Transnet. So it was almost like you didn't listen to the PR. You had a look at what Transnet was actually doing on the ground, did your research and homework, and then said, these guys are in more trouble than the market seems to think. And I was fascinated to see you sold it at over 300 Rand a share, having banked a 60 Rand dividend. It's now sitting at just over 200 Rand a share. So great deal. But would you go back into Thungela now that we are hearing that maybe Transnet's going to get fixed?
Look, it's interesting as I think you're spot on there. We've been having this debate actually in the last week in the office, David, and I have to say, is it time to go back in? Because we're expecting a very, very attractive dividend to be announced kind of next month, and the results probably somewhere between 40 and 60 Rand dividend on $200. I mean, that's 20-30% dividend yield. But the issue you have is coal prices have come down aggressively from peak levels. And what's happened is Europe obviously prepared for a very cold winter. They bought lots of coal stockpiles in. You would have seen they filled up their gas storage facilities. And then we had this 2-week very hot stint where they didn't have to burn much gas, and it basically completely released the pressure there. So I think where we are right now, they've probably got some excess gas and some excess coal given how the winter's played out. So in the short term, the demand is lower than the supply, we think. So it's kind of a bit of on a knife edge at the moment. Like, we're having a debate, but I'm not going to commit to what we're going to decide. But there is a level where we'd happily get back in.
Sounds like a fascinating life that you have, where you're watching so many moving parts.
I honestly, I tell friends and family and other young people, I think it's one of the best jobs in the world that we have. It's certainly something where you're never going to get bored. There's always work to do. There's always a sector somewhere in the world or somewhere in SA that's doing well, even when other things are tough. But the one thing you do need is it's not an industry to enter if you don't have fairly high level of resilience. Because even if you do the best work and you work hard, and I think you're bright and you've got a good investment philosophy, you're going to get stuff wrong, and it's painful. And you always, I think the stuff you get wrong hurts so much more than the winners. I mean, so you're going to take emotional knocks. I think it's a great industry for keeping people modest. Like, you can't have ego here. If you've got ego, the market's going to teach you a lesson very, very quickly. You got to learn. I'm going to make mistakes. I need to learn from them, get over them, and move on. So I think if you like an exciting job where there's new things happening all the time, but if you can handle those emotional knocks, I think it's a brilliant industry to be in.
Being an actuary, your traditional route would have been into an insurance company and producing insurance products, etc. But what you're doing now seems a heck of a lot more exciting anyway. But how did you make that change, given what the traditional career path would be for an actuary?
Alec, I did start at All Mutual, and I worked in their life insurance product development. So we were doing life and disability insurance products that competes with Discovery and Sanlam and all that. And I spent about 18 months there. And then I think two things. Well, firstly, I had traded kind of shares during university. So I think I got bitten by the bug there that I saw this was fairly exciting and interesting. And then spending 12 or 18 months in the insurance industry, I just fairly quickly saw that it's been established for 100 or 100 plus years, life insurance. Nothing's really going to change. Every year you reprice the products, you try to come up with one or two additional product features, but then in the end, it's a product that's going to pay you out when you die or get sick. I mean, the product's been designed and it serves a good purpose, but there's nothing new happening. So I just saw, as someone that wants to be stimulated and wants to learn new things for my entire life, this was not going to make me happy. And effectively, I realized I've got to do something else. I looked around, and fortunately, someone I knew put me, actually Jan van Niekerk, that I'm not sure that used to work with Peter at RCM or probably still does. Kind of his wife was a teacher at the high school I was in randomly, and I somehow spoke to her. She referred me to him, and then got to Peregrine Capital. And I think at the time, I just love what these guys did so much. I actually think I took a 20 or 25% pay cut to move across, because I just saw it looks awesome. I just need to do this. It doesn't really matter what the pay is. I just need to do what I love. And then obviously it fortunately ended up working out well in time.
Well, another Buffett recommendation. Jacques, the performance of the funds, you've already given us the numbers. They have been exceptional. They continue to be exceptional. And I guess you're only as good as the last time you went into bat. And last time for you that you went into bat was 2022. And there, most people lost money. People on the JSE maybe made a little. But you guys still delivered double digits. How do you do that?
So, Alec, our model is trying to look for ideas where everyone is not looking. I mean, we're happy to find ideas that everyone's seeing, but I think because we're a boutique-size fund, it means you've got a wider universe than a large, long-only manager, and that gives you the opportunity to find opportunities that others might not in reasonable size. So we don't need the overall market to do well for us to do well. And I guess if I look at the key winners last year, I'll maybe just touch on one or two, but it's shares we found that didn't need the market to do well. So OUTsurance was, or it's called OUTsurance now, it was RMI, you'll know it, Rand Merchant Insurance last year. And there we identified that within that stable, OUTsurance was a fantastic business. I personally think it's a top 5 company in SA if you look at what they've built in 20 years there. And one of the very few that's been able to replicate success in other countries, showing how good they are, that they went to build fresh business in Australia that's now 6% of the Australian motor market from scratch, which is fairly unique. I mean, most of the African companies go buy an established business and they somehow mess it up and then have to leave or sell it or lose money on it. I mean, someone to start from scratch, just spend money on marketing, build a team there, truly exceptional. And that was sitting in there with Discovery and momentum with it. And we knew, and ourselves in the market, they wanted access to OUTsurance. You didn't want the other stuff with it because very few investors want all 3 of those. So when Herman Bosman decided to clean up the structure and unlock that value, we just saw that as a fantastic opportunity. And we knew that regardless of whether the market did well or poorly, offshore investors and SA long onlys would eventually see the value we saw in OUTsurance. And so as a hedge fund, you could put that trade on before it. You buy the RMI, you short out discovery and momentum, and you create your outsurance before the long only scan. And then eventually when unbundling happens, they will then come by, or the offshore investors will then come by. So that's really the bread and butter stuff that hedge funds can do that you can't do if you don't have the flexibility of our mandates. So that was one. And then Tingela that we touched on was another. I think those two made a key difference. But then also, I think running more conservative portfolios, running more cash, trying to be a bit more in and out of opportunities last year than just trying to ride the overall market. I think all of those things added up.
Mm-hmm. And looking ahead to 2023?
Look, as you said, your scoreboard starts fresh every year, so we've got to go do it again in the year ahead. We are somewhat cautious, especially after the rally we've seen so far in Jan and into early Feb in SA and globally. We've been selling into this, so we've been taking down our overall market exposure. We're only about 50% exposed to the equity market right now, Alec. And of that 50, 20% of those, we've got put options on the US market to protect us from downside. So we are very conservatively positioned, and even more than last year, saying we need to find specific ideas where there's catalysts or value unlocks at specific companies, or do pair trades in various sectors to generate return for investors this year. But we don't want to take massive overall market exposure. And the main reason being we're still unsure how the aggressive rate hikes of the late last year will feed through into the economy and markets. For now, the US economy just seems to be pumping ahead, which makes me somewhat nervous that they've got to push harder on rates or keep it higher for longer, which probably adds more risk. So you always have to balance protecting the downside and then still being on the front foot and not just sitting too conservative. So we're trying to do both of those, but probably leaning somewhat conservatively right now, Alec.
And so you need to, if you're going to have a portfolio that doesn't lose money over 25 years. Congratulations ahead of time. Are you planning something real big for June for your 25th anniversary?
There will definitely be something. We haven't decided and we haven't given too much away, but I think it's you only turn 25 once, right? So I think we'll have to do something, celebrate with some of our long-standing investors and some of the newer investors. I think it's something worth celebrating, and almost just committing to clients again that we're going to be as committed and as driven as we have the previous 25 years to keep getting runs on the scoreboard for them.
I'm sure those guys who are on the 100X club, the early investors who stayed all the way through, would be quite happy to chip in for a bit of the champagne. Jacques Conradie is the Chief Executive and Portfolio Manager at Peregrine Capital. And I'm Alec Hogg from BizNews.com.